Wall Street is hitting the panic button on Zoetis, and frankly, they are handing us an absolute gift. While institutional investors are selling the news and running for the exits, my conviction is only growing. As ZTS stock continues to drop, it is rapidly becoming my highest conviction idea in the entire market right now. And by the end of this video, you'll see exactly why. Today, we are stripping away the market noise. We are going to dissect exactly why Zoetis is crashing, rip into the core business model, uncover the massive competitive advantage, and put their fundamentals through a rigorous quality scorecard. Finally, we'll run the valuation to see if this drop has created the ultimate buying opportunity. If you are serious about finding elite business trading at a discount, you are in the right place. Hit that subscribe button to join the Moneyjourney channel, and let's dive into the data. So, why is a fundamentally elite business suddenly in a free fall? The recent crash is entirely driven by short-term headwind risk and uncertainty. The market hates uncertainty, and recent noise surrounding regulatory scrutiny and isolated reports regarding their osteoarthritis drugs have spooked investors. Wall Street is currently pricing Zoetis as if these temporary headwinds are permanent impairments to the business. But let's look at the actual business model. Zoetis is the undisputed heavyweight champion of animal health, dominating both the companion animal and livestock markets. They don't just sell drugs, they provide a complete ecosystem of vaccines, parasiticides, diagnostics, and therapeutics. Their competitive advantage, their economic moat, is staggering. First, they have unmatched R&D scale, allowing them to out-innovate the competition. Secondly, high switching costs. Veterinarians are incredible sticky customers. Once they trust a diagnostic machine or a treatment protocol, they rarely switch to a competitor to save a few pennies. Finally, they benefit from highly fragmented customer base, giving Zoetis immense pricing power. However, as elite investors, we must respect the bear case. The primary risks here are margin compression if inflation continues to elevate manufacturing costs, the threat of generic competition as key patents expire, and the ongoing risk that regulatory bodies could require restrictive labeling on their blockbuster drugs. But the question is, are these risks already priced in? Let's look into Zoetis fundamentals using our Moneyjourney stock analyzer. Zoetis trading at 9.6 EV to EBITDA, a forward P of 10.2. Which means a 9.8 forward earnings yield, almost a 10% yield based on next year earnings, which is really high, especially for a company like Zoetis, which has been a really good growth company with plenty of competitive advantage and a leader in their market. Bear in mind, Zoetis used to trade at a forward P of 30. Right now, the stock is down almost 70%. It's trading at a forward P close to 10. So 34 repeats for companies that have high competitive advantage, a wide moat, and right now investors do not believe that the wide moat that Zoetis has or the bear cases for the company will impact the future earnings of the company. That's why Zoetis is now trading at like a stalwart and not a growing company. But is that really the case? Does Zoetis really deserve a 10 for PE? We'll need to discuss that, and we will see in the future. Free cash flow yield of almost 7%, which is really high. In terms of margins, gross margins above 70%, net margin close to 28%, which is really good. They have a very good balance sheet. If you net out the cash and short-term investments with their long-term debt, you have a debt position, net cash position of only $7 billion, so they could pay their debt with 2.5 years of their free cash flow, which is really good. Return on equity 67%, return on invested capital of the last 5 years average 24.5. They pay a healthy dividend, almost 3%, which is very good, and they are doing plenty of buybacks because they believe the company shift. Trading, it's down 40% year to date. In terms of the quality scorecard, where you do our quality analysis to see if this is a really great company, They have been growing revenues 5.5% compound annual growth rate. Analysts expect the company to grow earnings per share at the rate 7.5%, which is a good, not as healthy as in the past. They have been growing double digits, but growing around 7 or 8% for a company trading at the forward P of 10, it looks very attractive. So, quality of their revenues, they have plenty of recurring revenue for their blockbuster drugs, so very steadily in terms of revenues grow each and every year, growing profits growing with healthy margins. If you look at their margins, gross margin above 70%, net income margins growing from 26 to 28%, free cash flow margins going to almost at the same of net income per share and free cash flow per share growing each and every year as well. So it is a steady compounder, Zoetis. So I really like this company because of that. In terms of fundamentally, look incredible, and our quality scorecard shows that. They product and process development, research and development, it's one of the best. They are leader. If you look to the top 10 animal drugs, for example, the most selling product, I would say 5 or 6 are Zoetis product, maybe 5. I've done that analysis when I researched this company, and that's incredible. One of the biggest companies in this area, the biggest, I would say. But they are facing plenty of competition from Elanco, for example, and other companies. Really great margins for the industry. They have better margin than competition. For now, they are maintaining profit margin, but one of the bear cases is that competition and generic drugs coming to the market because some patents from Zoetis are expiring. For now, they are maintaining their profit margin, but of course, if their margins will tend to go down in the future, it will be a very valid bear case. In terms of that, they could pay all their debt in 2.6 years, so very great, especially for this sector. Rates of return invested capital, almost 25%. So. Management, reputation, culture in the company, not the best, but one of the best. So I really like their management. Now the company is very cheap and they are increasing their buybacks, which is a good sign. In terms of their moat, I believe still that they were almost a monopoly, but I believe their moat will be wide, or it's wide and it's enduring for now, but they could face plenty of headwinds in the future. But for now, I believe it's a wide moat company, and free cash flow per share has been growing steadily, and they've been returning capital to the shareholders. With that, we come with a quality score of 87.8, which is one of the best companies we have on our watch list, and a really great company. So it's a company based on this analysis that I really love to own. Full disclosure, I do own some really good position in Zoetis since I've been looking into that, and it looks very attractive. Yes, let's do our valuation analysis. So for this analysis, it is a US company. In terms of business risk, one of the leaders. Of course, there are the risk of their margin going down, a lot of bear cases, but not bankruptcy risk. So I would say low risk, even though they could face plenty of competition. So with that, my discount rate for my base case will be around 11%. So base case, growth rate around 5% revenue growth. Yes, it's gonna be difficult to grow 7 or 8% or 10 plus percent earnings per share. So I'm assuming a conservative growth rate around 5% in their revenues. In terms of future free cash flow margins, right now they have net income margins around 28%. Analysts are expecting that margins to for their leverage to increase, so their margins to expand. I'll be considered to assume the same 28%. I believe they could get around 32% free cash flow margin in the future. In terms of PE, yes, they used to be a company that deserved a 30 PE, and right now it's trading at the 10 PE, which I believe it's very low, especially for the company, for a leader in this market. So I also consider for a wide moat company, I always try to assume around the 20 future PE, which is a 5% earnings yield in 5 to 6 years. I believe it's fair. Of course, if if their growth resumes about 10%, a 30p will be, and if their profits continue to grow at the past rate, I would say, of course they could deserve a 30p, but I'll be conservative in my analysis. But based on this assumption, I believe Zoetis is worth $119.9, $120 per share. Right now, the company is trading at $75 per share, which means 37.5% discount or margin of safety. Bear in mind, we already have some margin of safety in our discount rate, in our assumption being conservative, so probably this margin of safety, to assume a standard discount rate of 10%, it will be a 50% margin of safety, which is on the right spot where we would like to buy the $1 for 50 cents. So it is a great company, it's a leader in the market that right now is facing some headwinds, some bear cases that it's really important for you to understand. So there is risk in this investment, of course, but that's why this could be a really great opportunity. To wrap this up, what we have here is a massive disconnect between price and value. Yes, there is a negative news around the company and a lot of regulatory uncertainty, but beneath that noise is an incredible business with exceptional fundamentals, expanding margins, and an ironclad balance sheet. Right now, the valuation clears tell us that investors are expecting the worst from Zoetis, creating a massive margin of safety for long-term buyers who are willing to step in when others are fearful. I want to hear from you. Do you think the current fears are justified, or is this the best buying opportunity of the year? Let me know your thesis in the comments down below. If you found value in this deep dive, make sure you subscribe to the Moneyjourney channel so you never miss our next stock analysis. See you in our next video.